Hello, and welcome to the third installment of the 4 webinars in Mayer Brown's Banking and Financial Services Litigation series for 2021. I am Ian MacDonald, co-leader of the firm's Global Litigation and Dispute Resolution practice and co-leader of the Banking and Finance Litigation practice. Our speakers today for today's webinar, entitled Special Purpose Acquisition Companies under SEC Scrutiny, Mitigating Potential Liability for Offering Participants, are Chris Haupt, Brian Massengill, and Anna Pinedo. Christopher Haupt is also a co-leader of Mayer Brown's Banking and Financial Litigation Group, concentrating on banking and finance matters, particularly cases involving cross-border issues, securitization, structured finance and derivatives, and asset turnover. He is a partner and joins us from our New York office. Brian Massengill focuses his practice on the intersection of litigation with accounting and finance issues. He is the co-leader of the firm's professional liability practice group and a partner based out of our Chicago and New York offices. And thirdly, Anna Pinedo is a partner in Mayer Brown's New York office and co-leader of our global capital markets practice. Anna concentrates her practice on securities and derivatives. Anna represents issuers, investment banks and financial intermediaries, and investors in financing transactions, including public offerings and private placements of equity and debt securities, as well as structured notes and other hybrid and structured products. Now, before we begin, we'd like to mention a few housekeeping announcements. Please note when accessing Mayer Brown webinars via our On24 platform, we suggest avoiding use of desktop virtualization software such as Citrix to decrease disruption or quality loss. Secondly, as listed under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there's no dial-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. If you have any questions that are unanswered during the presentation, I would invite you to submit them using the Q&A feature on the left side of your screen, and we will do our best to follow up with you directly after the webinar has ended. Regarding CLE credit, we will be providing an alphanumeric code during the presentation. In order to receive CLE credit, participants must record this code on the virtual sign-in sheet that was emailed to you with the login instructions for today's program. If you need CPD points, please send your request to our Learning and Development team at ld@mayerbrown.com. The forms are also available to download on the right-hand side of your screen under Resource List if you need them. Now, with all of that said, let's get started. Over to you, Anna.
Thanks, Ian. So we'll start out by discussing an overview of the SPAC market. We'll talk a little bit about forecasts and the questions that the SEC is raising regarding the availability of the safe harbor under the PSLRA for forecasts. We'll talk about the conflicts of interest that are inherent in the SPAC structure and some of the claims that might arise in connection with those conflicts of interest, and finish off with a discussion of securities disclosure issues and PIPE transactions. So we'll start with a discussion of the SPAC market. As shown on the slide, SPAC IPO volumes have been surging, reaching record volumes in 2020, and volumes in 2021 have already surpassed those of 2020 and show really no signs of abating. On this slide, as we indicate, the volume of SPAC IPOs that are shown here are an almost 50% share of overall IPO volumes in the United States. In the first quarter of 2021, SPAC activity continued, and as indicated in the pie chart, the activity was pretty diversified across industries. In May, as we indicate on the slide, there were over 134 SPACs that were seeking mergers, and in total, 427 SPACs seeking targets. So quite a lot of SPACs that were still looking for private company targets, indicating that there's really a fair bit of de-SPACing activity yet to come. On this slide, we just give a little bit of a sample so you have a flavor of the kinds of SPAC transactions that we've seen in recent months. So a variety of companies across industries from fintech, consumer products, and agritech that have completed notable SPAC transactions. Now we'll dig into some SPAC basics. On this slide, we just have a very basic schematic of the SPAC structure. So a SPAC is essentially a blind pool that raises cash in an initial public offering where a financial sponsor, oftentimes a private equity company, offers shares of common stock, a class of warrants, paired together and sold as a unit, and the cash that's raised in the IPO is held in a segregated trust account. Those monies are earmarked and are meant to be accessed only within an 18 to 24 month period of time and spent in connection with an acquisition of a private operating company. That's referred to as that target operating company in the diagram. In the initial business combination, the target operating company merges with the listed SPAC, and the eventual outcome is that the target operating company becomes the public listed operating company. Many private operating companies, including successful unicorns, have been looking at initial business combinations with SPACs as a very attractive alternative to IPOs. So not all SPACs are the same. Some are focused on a particular industry, maybe fintech, maybe consumer products. Others have a geographic focus. Others yet have no mandate. As I mentioned, all of the IPO proceeds go to that trust account, and the IPO investors receive units that subsequently separate into separately traded warrants and common stock. Now here we get to one of the principal conflicts of interest that the SEC has focused on. If SPACs don't complete their business combination in that 18 to 24 month period of time, and then they have to liquidate the trust and redeem out the investors. So the SPAC sponsor is really highly motivated to find a target company. And of course, the interests of the sponsor may differ from those of the SPAC stockholders. That process that I described earlier of the SPAC combining with or merging with the private target company is the process that we refer to as de-SPACing. Investors do have a say or a vote in this process. So the SPAC has to obtain the vote of the SPAC stockholders in favor of the initial business combination. And investors do preserve the right to redeem their common stock regardless of whether they vote for or against the transaction. They also have the opportunity to hold the warrants even if they decide that they're going to redeem their common stock in connection with the deal. So as I mentioned, post-business combination, the target becomes the surviving entity and the operating public company. As a result, the target company has to be public company ready. Combining with and into a SPAC appeals to a lot of private companies. It's appealing because in some ways it could be faster than undertaking a traditional IPO. Of course, that's going to depend on the nature of the negotiating process between the SPAC and the operating company, the length of time necessary to navigate the regulatory approvals, including getting through the SEC process. Of course, it's also going to entail preparing lengthy disclosures, including disclosures that are very similar to the types of disclosures that would be expected of an IPO issuer. And those are going to be prepared in connection with a proxy statement or a proxy prospectus. Probably the most appealing advantage to combining with a SPAC for a private company and boards of directors of private companies is that a combination with a SPAC provides a level of certainty that might not be attainable with an IPO as it relates to valuation and overall consideration. The letter of intent that's entered into with a SPAC sets the valuation for the private company, and that's entered into very early in the process, whereas the IPO price range and the overall value for a company in connection with an IPO is really set far later in the process once management time and a significant amount of expense has been devoted to the IPO. While it's possible that a repricing could occur and renegotiation could occur in connection with a de-SPACing, we haven't seen too much of that as yet, and the market has been fairly strong. So there's a level of certainty associated with the de-SPACing process that we haven't really seen in connection with IPOs, given that the IPO windows tend to open and close, and there tends to be a fair bit of volatility associated with the IPO market. Finally, as we'll talk about in just a moment, there's a little bit more flexibility in connection with merger-related communications, as well as the possibility of using forecasts for the target companies in connection with marketing the PIPE transaction that goes right along with the de-SPACing, and subsequently in connection with investor outreach in the de-SPAC process. So it's not all positives, of course. As I mentioned, sponsors like SPACs because they are lucrative for sponsors. Sponsors receive an equity interest, the founder's shares in SPACs for nominal consideration. They also receive warrants. For stockholders, SPACs create short-term arbitrage opportunities, and because of the unusual capital structure that I mentioned, the common stock and the public warrants, in addition to the founder's warrants, there are arbitrage opportunities that may result in unusual trading in in the securities of SPACs. And finally, the redemption right for SPAC stockholders can create some uncertainty about how much cash is going to be left in the trust account for the combined company going forward. For the combined company that is emerging from the de-SPAC process, it also has to consider that it may lack the investment bank and institutional investor support that it could have had it gone through a traditional IPO process. Finally, a lot of companies think that a SPAC process is cheaper than a traditional IPO, which of course is not always the case. So on this slide, we have a quick little process overview diagram that illustrates the principal steps in the de-SPAC process. One of the most time-consuming of the steps indicated on that schematic is the preparation of the proxy statement or proxy prospectus. So as I mentioned, in connection with the de-SPAC process, the SPAC has to prepare a proxy statement on Schedule 14A, or alternatively a Form S4 or F4, to use to solicit the vote of its stockholders. And in that document, the target company is going to describe its business, its financial results, and all of the risk factors associated with its business and future prospects. The proxy statement or proxy prospectus is really going to contain almost all of the same information that would be in an IPO document. On these next two slides, we just list, so that you can get a sense, the basic requirements for an S4 F4, and these are substantially similar to what would be required in connection with a proxy. It's a substantial undertaking, and the disclosures really require the cooperation and collaboration of the entire working group. With that, I'm going to hand it off to Brian, who's going to talk about the disclosure-related claims that may arise in connection with the proxy or S4 in a de-SPAC.
Thank you, Anna. I want to address sort of disclosure-related litigation claims. I'd submit that much of the reported litigation boom relating to SPACs really involves disclosure-related claims that are filed after the issuance of the preliminary proxy, for example, and before the completion of the de-SPAC transaction. I think one way to look at these are the plaintiffs' law firms are adapting the standard playbook they use for public M&A transactions, public mergers, to the SPAC world. So you will see the filing of complaints, both in federal court, asserting federal securities claims under Section 14A of the Securities Exchange Act, and you also see complaints filed in state court asserting breach of fiduciary duty claims alleging purported disclosure deficiencies. I think, for example, there's reports of in excess of 30 cases filed in New York State Court in 2021 relating to SPAC transactions alleging breach of fiduciary duty claims. I think as you'll see these play out, they'll reveal themselves as really disclosure-related complaints, and I would expect that they would be dismissed shortly after the completion of the de-SPAC transaction. And the disclosure claims are typically resolved by additional disclosures in either an amended proxy or, is the more common practice now, the filing of a Form 8K in advance of the shareholder vote. These additional disclosures are designed to, in quotes, moot the purported disclosure deficiencies that have been identified by the plaintiffs' firms, either in the complaints, federal court, state court, and also in demand letters that are just sent to the target or the SPAC. And I think, so you will see supplemental disclosures being submitted, and then after that, the complaints are typically dismissed, and the plaintiff's law firms will seek what's referred to as a mootness fee. They will assert that they provided a benefit to the shareholders by causing the company causing the company to add additional disclosures that benefited the shareholders. I think that these cases are really, sort of like the M&A public cases, and they're just a cost of doing business in the SPAC world, unfortunately. But these cases are really distinct from a set of cases we'll address later, and that's the cases that are asserted after the de-SPAC transaction is completed based on some typically post-closing event or occurrence. And those are the more substantive litigation, which we'll address later. With that, I will turn it back over to Anna.
So we're going to turn our attention now to the use of forecasts. One of the most notable trends related to the SPAC boom is that many of the companies that have chosen to merge with SPACs versus the traditional IPO route is that they've been earlier stage companies and largely pre-revenue companies. And that trend probably is most notable in connection with the SPAC activity in the electric vehicle sector. Now, we're just highlighting this as an example because it's illustrative of the point. We're not signaling out any particular company, but here are a handful of companies in that sector that have chosen this particular path. So early stage companies have been particularly drawn to combining with SPACs as a liquidity alternative, and that's largely because, as I alluded to earlier, in combining with a SPAC, the target company is permitted to use forecasts, and those forecasts are shared in the process of courting or meeting with potential SPACs, and the same forecasts are used by the target company in connection with marketing to and soliciting indications of interest and ultimately subscriptions from institutional investors in the SPAC PIPE transaction that's marketed alongside the negotiation of the definitive business combination. So the objective in the context of a de-SPACing transaction is for the definitive business combination agreement to be announced concurrently with the announcement of the entry or execution of subscription agreements with institutional investors for a PIPE transaction. And the purpose of the PIPE transaction, as I mentioned earlier, is to give confidence to the market generally that there'll be sufficient cash raised in the PIPE transaction to mitigate the possibility of cash leaving the SPAC through a high level of SPAC stockholder redemptions. So the same forecasts that are used in the PIPE presentation that are subsequently publicly filed in an 8K by the SPAC also find their way into the S4 or the proxy and eventually into investor presentations that are used by the SPAC when it's out soliciting SPAC stockholders to vote in favor of the business combination. So by contrast, it's worth noting that if an issuer were doing an IPO, generally its business model would be shared or discussed only with the investment bankers on the transaction, and the business model would be discussed as well with the equity research analysts of those investment banks that are serving as underwriters, so with institutional investors or professional investors only. And those equity research analysts would form their own views and develop their own forecasts, which they might then talk to investors about, but the forecasts would never be public. So a lot has been made in the popular press about this ability to use forecasts as one of the most important differentiators for private companies that are evaluating liquidity alternatives and trying to choose between undertaking an IPO and combining with a SPAC. And eventually that really has gotten the SEC's attention. So looking at where the SEC sees these projections or forecasts, the SEC will generally look at the forecasts in the context of reviewing the proxy prospectus, which will contain a section generally titled Discussion of or Background of the Merger Transaction. And in this section, there'll be a lengthy discussion regarding how the SPAC sponsor came to determining the valuation for the target. And it's in that context that there'll be a detailed discussion of the forecast and the analysis that was undertaken in arriving at the valuation for the target. So SPACs and SPAC sponsors take some level of comfort in knowing that as public companies, the forward-looking statements that they make benefit from the safe harbor that's available under the Private Securities Litigation Reform Act. And that's in contrast with IPO issuers which don't have available to them the safe harbor under the PSLRA. So of course the safe harbor is available subject to certain parameters. And it's available to the extent that the forward-looking statement is not misleading and the forward-looking statement is identified as forward-looking, accompanied by meaningful cautionary statements. Of course, what's forward-looking is going to depend on the context, the facts, and the circumstances, and the type of language that is accompanying the statements that indicates that the actual content of what's expressed is forward-looking, and then, of course, whether the statement is accompanied by meaningful cautionary language is really going to be subject to the facts and circumstances. Perhaps most important, when the statement was made, the maker of the statement can't have known that it was untrue, and the statement can't have been misleading or know that the risks that were described already had come to pass. So Acting Director of the SEC's Division of Corporation Finance, John Coates, recently raised some ambiguities regarding the scope of the PSLRA in the context of SPAC transactions. And Coates suggested that at the time that the PSLRA was made, there was a lack of certainty when the PSLRA referred to initial public offerings, whether initial public offerings in the context of the statutory language really referred solely to traditional IPOs or to the first time that a security was introduced to the market and really came to have a public trading market. So he called into question whether transactions like direct listings and transactions like de-SPACing transactions ought to benefit from the safe harbor, and in particular, whether market participants should take as much comfort as they have been taking regarding the availability of the safe harbor. Of course, he also reminded market participants that the safe harbor really was only applicable in the context of private litigation. It really didn't protect from commission actions, and the safe harbor didn't protect against false or misleading statements. So we don't know whether current SEC Chair Gensler, who came into his role shortly after these statements that were made by then acting Division Director Coates, whether Gensler shares these views regarding the PSLRA's exclusion for initial public offerings and their applicability to de-SPACing transactions. There's been pretty notable silence from Chair Gensler regarding SPAC transactions, including in Chair Gensler's first testimony on the Hill. So it's unclear what the views of the current SEC chair are with respect to the safe harbor. Of course, to the extent that the safe harbor is not available for the forward-looking statements that are made by target companies, it's also not clear that that would necessarily change the de-SPAC process in a meaningful way. Regardless of the availability of the safe harbor, participants in the process can do their very best to diligence forecasts, and that can take place through working group calls, through investigating and asking questions about the forecast, through verifying the assumptions that are used, through engaging experts to probe some of the forecasts. And of course, all of that work is geared to ensure that the forecasts that are made are going to represent the best assumptions and assumptions that are made in good faith. Now, even with all that work and even assuming that the forecasts are diligence and that the forecasts are accompanied by cautionary statements and by well-crafted risk factors, even given all of that, there's no assurance that forecasts will be met. And we've witnessed, again, continuing our example in the electric vehicle sector, some disappointing results from the first set of electric vehicle companies that completed their de-SPACing transactions. And so with that, I'm going to hand it off again to Brian to talk a little bit about what happens when forecasts aren't met and things go wrong.
Thank you, Anna. We're going to turn to what happens when forecasts are missed after the conclusion of the de-SPAC transaction a little later in the program. First, I want to talk about here the litigation claims in connection with forecasts that are of the disclosure-related variety. You know, as we talked about before, much of the litigation boom are these sort of disclosure-only claims filed by the plaintiffs' firms. And invariably, they raise issues around the forecasts that have been included relating to the target that are in the proxy statement. Typically, there will be allegations in the complaints or in the demand letters asserting that the information disclosed about the forecast is incomplete or misleading, and they would look to have additional detail added to the disclosures regarding the forecast. For example, they'll say things like, you know, you should provide all line items that comprise EBITDA that's shown in a forecast, or that you need to provide more information on the assumptions relating to forecasted revenue. I would say that these are the types of allegations around forecasts that are in the standard plaintiff's firm playbook. And again, as we talked about before, these can either be brought as Section 14A claims in federal securities cases filed in federal court, or also in breach of fiduciary duty cases, or as I said, demand letters. You know, typically, again, these would be resolved through some form of a supplemental disclosure to moot the complaints raised by the plaintiff's firms. And then as we talk about, that's really sort of different in kind than the post-de-SPAC transaction cases where there is, for example, a shortfall to the forecast or another event that arises after the de-SPAC transaction that I would say leads to, well, I'll say more serious litigation.
Thanks, Brian. We're going to talk now a little bit about some of the embedded conflicts of interest in SPACs and the de-SPACing process. So as we mentioned at the outset, the basic SPAC structure and the de-SPACing process raise a number of actual and potential conflicts. Some of these could be mitigated, and some are just inherent to the structure. So we're going to talk about how to address these, as well as the SEC staff guidance regarding the disclosure of the conflicts of interest. So first and foremost, there's the economic interest of the SPAC sponsor. So the SPAC sponsor, as we noted earlier, typically receives about 20% of the SPAC's common stock. I say typically because in some recent, particularly large SPACs, the SPAC sponsors have waived a portion of the typical SPAC equity interest, and there have been some instances in which some of the typical incentives have been forfeited or have changed. But in the normal SPAC, the sponsor receives approximately 20%. That's generally referred to as the founder's shares. They get these shares for really nominal consideration. The nominal consideration is used to pay some of the SPAC's expenses in the lead up to the de-SPAC process. Those shares are really locked up and transfer restricted for up to a year following the de-SPAC process. As well, the sponsor also purchases warrants, again, for nominal cost from the SPAC. The economics of those warrants are identical to the public warrants. And of course, those warrants can have really substantial value, particularly if the target company is successful. Occasionally, the sponsor will also have a management contract, and that will entitle the sponsor to certain management fees even after the initial business combination. And of course, the SPAC is going to have to make its initial business combination within a set period of time, and that's usually outlined in the charter, and that's either 18 to 24 months. The SPAC could hold a vote to extend the deadline. In this environment, we haven't seen very many votes, many stockholder votes to extend the deadline, so it is possible. At the end of 2020, the SEC's Division of Corporation Finance released a guidance note on disclosures that it was expecting to see in the context of proxies and proxy prospectuses for de-SPAC transactions. And in the guidance, it outlined that it was expecting to see much more detailed and transparent disclosure relating to conflicts of interest. And really underlying all of the disclosure guidance, which actually goes on for several pages, we've only summarized a few bullet points here, or extracted a few bullet points here, is a very clear belief by the staff that investors don't have a complete understanding or transparency regarding how the interests of the sponsors differ from those of the stockholders, and really what's motivating the sponsors or how sponsors might benefit financially from the initial business combination. So you see some of the questions there at the bottom of the slide that the SEC staff expects to see answered in the disclosure. Here on this slide, again, additional questions that the staff expects to see answered in proxy disclosure. And this goes to a different point that the SEC staff has been raising in its comment letters in reviewing proxies. There have been many serial SPAC sponsors. In other words, SPAC sponsors that are doing, SPAC number 1, number 2, number 3. And there's some level of skepticism on the part of the SEC staff, and a little bit as well, the public generally, that when the SPAC went public, SPAC 2 or 3 or 4, that the SPAC sponsor truly did not have an identified target, because some of the target companies or the business combinations are coming very close on the heels of the completion of the SPAC IPO. And it also has triggered quite a number of SEC comments inquiring about how much diligence, how much investigation the SPAC sponsors really did, and how much negotiation to get to good business terms, and how hard a bargain did the SPAC sponsor strike with the target company on behalf of its stockholders when it was reaching the terms of the initial business combination. So all of this is disclosure that the SEC staff expects to see, and of course it goes right to the root of some of the conflicts of interest. Now, the SEC is also focused on conflicts of interest that may exist on the part of financial intermediaries. There are various financial intermediaries that may be involved along the way. So, of course, there are underwriters that are involved in the SPAC IPO. Those investment banks that serve as underwriters may have a number of different roles throughout the process. After the IPO for the SPAC is completed, they might serve as capital markets advisors, helping the SPAC to identify or vet target companies. There might be an M&A financial advisor to the target company. That same entity might be an advisor in connection with the PIPE transaction or a placement agent. So there may be a number of different roles that the same institutions are playing. From time to time, although it hasn't become all that common yet, there may be instances where the SPAC's board of directors or the target's board of directors may engage a financial intermediary to deliver a fairness opinion in connection with evaluating the fairness from a financial point of view of the terms of the business combination. Here, too, it's really important to assess the independence of the firm that's rendering the financial opinion. So just as the SEC staff was interested in careful and clear disclosure regarding sponsor conflicts, the SEC staff also was interested in disclosure regarding all the various fees and roles played by financial intermediaries. So, for example, in its guidance, the division highlighted the different roles that it has seen financial intermediaries play and has asked a number of questions in connection with that, as you see at the bottom of this slide. And finally, here, the SEC has been issuing more comments along the lines that we outline here on slide 46 regarding the different services that the same banks have been providing and the compensation for those services that might suggest that they're providing conflicted advice. So with that, I'm going to hand it off to Brian again.
Thank you, Anna. As Anna's addressed, we've talked about two of the sort of SPAC-related issues in the de-SPAC transaction. One was the use of forecasts, and the other is the potential conflicts from the SPAC structure. I think now we're going to address how we see those issues playing out in some of the recent cases that have been filed relating to events that occurred after the de-SPAC transaction. So there's been a number of cases filed after the completion of this de-SPAC transaction where the performance of the stock is disappointed. You can see these claims have arisen through situations like an announced shortfall to the forecasts that were included in the proxy. I think Anna alluded to some of these relating to some of the electric vehicle manufacturers. There's at least one case where the target in the SPAC transaction announced shortly after closing that it lost its key customer that was responsible for approximately 40% of its business. And then you also see it now more frequently in a series of the recent cases relating to short seller reports. I think this is similar to a process that we saw a few years ago in the litigation relating to the reverse mergers by which Chinese companies became public. You saw that they were then subject to short seller scrutiny, which leads to questions about their underlying business operations and resulting stock price declines. I think this is sort of similar. There's not a long track record of public information relating to the SPAC target. And so there's an opportunity for short sellers to dig in and issue reports. And you've seen that result in some significant stock price declines, and some of the examples are listed. And these complaints about the post-transaction events implicate the potential conflicts. And we'll address some of those. But for example, if a transaction needs to be completed in a short period of time, that has led to allegations that there wasn't sufficient diligence around the target because the transaction needed to be completed within the window. And so I think you see all these conflicts sort of playing out as allegations relating to supporting allegations of fraud or intent that are necessary to bring some of the causes of action that are being asserted. And these cases are being brought both as breaches of fiduciary duty cases in state court and as federal securities actions. I want to first turn it over to Chris to address the breaches of fiduciary duty actions that we're seeing.
Thanks, Brian. So the fiduciary duty claims will mostly be governed by Delaware law, and Delaware, of course, generally applies the business judgment rule. But the standard shifts to entire fairness, which is a much more searching scrutiny of the transaction, if the directors had a conflict or otherwise there was a breach of fiduciary duties. And entire fairness is not only a higher substantive standard if the conflict is proved, but if it's merely alleged at the pleading stages, it really changes the complexion of the litigation. It's much more time-consuming and requires a lot more discovery. And so, not surprisingly, cases in this area have focused on conflicts, including some of the ones that we've discussed already relating to the compensation structure of the sponsors and the deadline, and there are allegations that those conflicts led to lack of adequate due diligence, lack of adequate disclosure, and just poor business terms from the perspective of the SPAC shareholders. Here are a few examples of those state law claims, just to give you a flavor of the types of theories that plaintiffs are pursuing. The first example is actually a federal securities case, but it alleges a conflict not only out of the sponsor's compensation structure, but also because they were serial SPAC sponsors, the plaintiffs alleged that they had an incentive to rush into an agreement to protect their reputations as ongoing deal makers and protect their future business interests. AP Services is almost a decade-old case filed in New York State Court, which also pointed to the stock and warrant structure, the deadline for the de-SPAC transaction, and it alleges that as the sponsor got close to that deadline, it had an incentive to enter into any transaction that it could find. And ironically, in assessing the pleading there, the court looked to the fact that that structure had actually been disclosed as a potential conflict of interest in concluding that it was a potential conflict of interest. So no good deed goes unpunished there. Two more recent and more typical fiduciary duty cases are in the next two bullets. And they're more typical because they relate either to the substantive terms of the de-SPAC transaction or, as Brian was saying, to facts that came out about the business after that transaction. Also, importantly, both of them are brought in Delaware Chancery Court, which is where you'll see most of this litigation going forward. Most SPACs now have forum selection clauses that require these kinds of claims to be brought in Delaware. Pell's was filed earlier this year, and sort of the opposite of the first two cases. It alleges that the conflict arose not as the deadline came nearer, but that the sponsor had an incentive to make a transaction right away so that it could just move on to its next SPAC. That complaint also includes some allegations about the specific corporate governance proposal in the proposed merger. They allege that the target directors would have excessive control over the post-merger board, including a waiver of the corporate opportunity doctrine in favor of those directors. And then the last example here, AMMO versus Multiplan, also in Delaware Chancery, really is an ambitious complaint. It takes aim at the whole, what it calls SPAC 1.0, which creates these ticking time bombs of dry powder It points to the compensation structure, which it says leads to inadequate disclosure and a failure of diligence, and it encourages the Chancery Court to make a pronouncement that general principles of Delaware corporate and fiduciary law still apply to SPACs, and the court should move on to, or the market should move on to what they call SPAC 2.0. And so with that, I'll turn it back to Brian to cover some other post-transaction claims in the federal securities law context.
Thank you, Chris. So I'm going to address the federal securities claims that have been recently filed relating to, I would say, events or announcements that arise after the completion of the SPAC transaction. And basically, a federal securities case under Section 10B, typically arises when there's been some form of a corrective disclosure made by the company that's triggered a material decline in the stock price of the company. And so the basic frame is that announcements made earlier were purportedly proven to be false or fraudulent when a subsequent announcement is made that sort of, is distinct from the prior announcements. So, for example, we'll turn to a couple of cases later where there was announcements made about the performance of a drug, early-stage drug, in trials that then proved to have issues later in time. And that later in time was viewed as a corrective disclosure, leading to a significant stock price decline, and that was the basis for a securities fraud allegation. And so I think typically these would be asserted more commonly as Section 10B claims, which is your sort of standard securities fraud claim, and under 20A, which is control person liability, which is the way you get to individuals that had control over the disclosures made by the company. There are claims that have also been asserted under Sections 11 and 15 of the 33 Act. I think it's going to be interesting to see how those cases play out in the context of a SPAC transaction, because there will be some challenges to plaintiffs being able to show that they have standing to assert the claims if they purchased the shares after the completion of the SPAC transaction. So it'll be interesting to see how that plays out in the litigation going forward. If the claims are predicated on the forecasts that were in the proxy, and then it turns out that the actual earnings were short from the forecast, leading to a decline in the stock price, there will be litigation around whether those forecasts included in the proxy are, as Anna was talking about earlier, considered forward-looking statements made in connection with the de-SPAC transaction, and whether they are available, whether the PSLRA safe harbor for forward-looking statements is available. I mean, this is essentially picking up on the points made by then Acting Director Coates and casting some doubts as to whether that safe harbor would be available. I think we'll see this play out in the courts in fairly short term, probably over the next year, because a lot of this can come out in a motion to dismiss, where the defendants will assert that the statements made were subject to the safe harbor and therefore aren't actionable. And so given that there's been some recent cases filed late 20 and early 21, we would expect to get some guidance from the court as to the availability of the safe harbor in fairly short order. And so I want to cover a couple of the recent examples of some of the cases filed. So Nikola Corp began trading on the NASDAQ in June of 2020 after it was acquired in a SPAC transaction. And in September 2020, Hindenburg Research publicly alleged that there was fraud in connection with some of the operations of Nikola. This is a fairly short time period between becoming public and this announcement in the short seller report. It led to a significant stock price decline. And then there were a series of class actions filed under Section 10B. And the SEC, as then not unusual after short seller reports that are at least on its face seem to be meritorious, there's an SEC investigation opened. And then that led to resignations of some of the individuals at Nikola. I'd say this is a case where the de-SPAC transaction and the conflicts are likely to sort of play out, at least in the background, sort of supporting allegations of fraud or extreme recklessness in connection with the statements made relating to the de-SPAC transaction, in large part due to the short time period between the de-SPAC transaction and where information was alleged to have been discovered that shows that they were false when made. I think this case is where you will see some of the allegations around the conflicts that we addressed earlier relating to the SPAC process play out in the litigation to support some of the required allegations to state a claim. Clover Health is very similar to the Nikola case in that it really arose from the same short seller issuing a report that cast doubts on some of the disclosures made relating to the de-SPAC transaction. Again, there's a fairly short time period in between the de-SPAC transaction and the short seller report raising these issues, again triggering a significant stock price decline. I would submit that short sellers are something that newly public companies through a de-SPAC transaction are going to have to learn to deal with. Long-term public companies deal with short sellers on a regular basis, and they sort of get used to doing it. But given a newly public target through a de-SPAC transaction, there is not the history of publicly disclosed results of operations, et cetera. They're just, I think, I would submit, are more susceptible to short seller activity leading to significant stock price reactions. And I think Clover Health is another example. And so I think that's, again, another case brought under Section 10B, and given the short time period, there are allegations that the conflicts that we discussed earlier relating to the SPAC structure are playing out in the background relating to the sort of motivations and other allegations needed to support the required scienter pleadings. A case we don't have on the slide, and a recently filed one, is a case called Immunovant, and it was filed in February. Again, similar. But this one I would sort of view as, I would submit, is more like there is a SPAC gloss on top of a fairly typical or standard securities fraud case. The de-SPAC transaction in that case was completed in December of 2019. And throughout 2020, there were public announcements about the progress the company was making on relating to its clinical studies on a new drug. And it was only in February of 2021 where they reported that there were some adverse events relating to the drug trial and that they had to pull the drug. And based on that announcement, there was a 42% stock price decline. I would say there is a SPAC gloss added to that, but I think this same type of claim, would be present whether it had gone public through a traditional IPO as opposed to a SPAC. And so I do think that there are, a number of cases that are just early stage company, early public companies. They typically will face a securities fraud complaint within the first 18 months to 2 years of the statistics of becoming public. And so I think some of the SPAC-related ones are just a function of a newly public company where there's an announcement that will trigger a stock price decline leading to a securities fraud case.
So we're going to just touch on the SEC's increased focus on SPAC transactions. You'll see some headlines here just noting that the SEC has been paying attention to the boom in SPACs and focusing on some of the issues that we've been talking about during our session today. In addition to the conflicts of interest and the use of forecasts, the SEC also has paid particular attention to some of the aftermarket performance issues relating to SPACs, and you see some of the statistics there. And these were cited by Reuters and Bloomberg, but also presented in a number of law journal articles and at a meeting at the SEC. So we've talked about some of the SEC statements already relating to SPACs, including the SEC's concerns regarding the availability of the PSLRA for forward-looking statements and forecasts made by target companies. We've also talked about the SEC staff disclosure guidance on conflicts of interest. In addition, the SEC staff has cautioned that private companies and their boards should be aware of all of the public company readiness requirements and the requirements to maintain disclosure controls and effective internal control over financial reporting once the target company becomes the public reporting company. Finally, the SEC staff has raised issues concerning the accounting treatment for SPAC warrants, suggesting that warrants that contain certain features should be treated as liabilities rather than equity. And this has required quite a number of SPACs to restate their financial statements, leading to a speed bump and potentially raising concerns that the restatements will trigger additional causes of action. Finally, as we've mentioned, PIPE transactions are important parts of the de-SPACing process. So almost 60% of the SPAC initial business combinations in 2020 were announced with concurrent PIPE transactions. That number, I speculate, is probably higher for the 2021 deals that have gotten done. It's really important to remember, as we note on this slide, that while these are PIPE transactions, the investors in these deals are focused really on the target. And there's no publicly available information about the target. So being mindful about the type of information that's furnished to investors in the PIPE transaction is very important. The type of information that's contained in the investor presentation, the diligence information that's made available to these PIPE investors, how these investors are wall-crossed so that they refrain from trading while they are in receipt of material non-public information about the SPAC considering this particular target company. Any diligence information that they might not be cleansed of once the de-SPAC transaction is announced, or if the transaction fails to proceed. All of those things are important to think about in advance of giving access. So we want to thank you very much for joining us today. We hope the information we shared with you was useful. Thanks for joining us. We hope you have a great day.